In this video, I'm gonna cover everything you ever wanted to know about deducting your vehicle if you're a business owner. And when I say everything, I mean that this is gonna be a masterclass on the topic of deducting your auto. It's likely the most comprehensive video out there on the internet, as I'm gonna cover a bunch of topics. I'll start with the basics, right? I'll talk to you about lease versus purchase. Then we'll talk about the mileage method and the actual method and how they compare and contrast. Then we'll discuss Section 179, bonus depreciation, and makers, which are all forms of accelerated depreciation. We'll talk tax strategy. Can you buy a vehicle on December 30th, use it 100% for business on the 30th and 31st, and write the whole thing off? Yeah, you can, and we're gonna talk about it. Depreciation recapture is another topic. What about an accountable plan? Should you be reimbursing yourself for these expenses? Or should this auto and this loan be on the financials of your business? The administrative home office and how to convert commuting miles, which are not deductible, into business miles. So yeah, this is gonna be a longer video, but use the timestamps if you wanna skip around. And if you commit to watching this video in its entirety, you may just get a complete understanding of how all this works for once and for all, instead of listening to a short reel or TikTok video or a 5-minute video on YouTube. But before I dive in, let me just quickly introduce myself if it's your first time watching. My name is Navi Miraj. I'm a certified public accountant who teaches entrepreneurs how to save thousands of dollars in taxes each and every year. I do that by providing free content you're watching right now, right here on social media, but also through a comprehensive course, which is designed to convert business owners from really knowing nothing about taxes and transitioning them and converting them into tax-savvy entrepreneurs who implement strategies that save them thousands of dollars in taxes. And like I said earlier, it's each and every year, not just a one-time tax savings. So if you're interested in learning more, you can click on the link within the description below or visit my website, which is navimirajcpa.com. Okay, so without further ado, I wasn't kidding when I said this will be a class. I'm actually sharing with you a presentation I did at the Tax and Legal 360 event in Phoenix. So grab a snack, maybe a drink, and enjoy the show.
We're gonna cover everything, guys. So we're covering what happens if you lease, what if you purchase, what if you take mileage, what if you take actual. We'll talk about all the various types of depreciation, 179, bonus, makers. We'll talk a little bit about some strategies, depreciation recapture. How do you take this deduction? For the accountants out there, should I be reimbursing these expenses through an accountable plan, or should I have this on the books of my business? And I'll unpack that a little bit later. The administrative home office. Why am I talking about home office when this is about vehicles? You'll see how that kind of is intertwined here. So lots to cover. Let's jump right in. But before I can jump in, I've got to kind of build some foundational understanding for you, because if I don't do this and I just kind of go right into the topic, your understanding of this will be very surface level. And it could just fall like a house of cards unless you understand sort of that foundational understanding. So let me kind of provide that to you. I have to tell you about tangible property and the different types of tangible property that there are. There are personal use property, business use property, or both. So what does this mean? Let me give you an example. So personal use property is any property which is not used in a business or an income producing activity. So an example of this would be the couch that's in the living room of your personal residence, okay? You're not taking deductions for that couch. It's personal use property. Business use property is quite the opposite. It's any property used in a business or income producing activity and is depreciated using the methods that we'll be discussing. So an example of this would be an MRI machine used in a physician's office, right? There shouldn't be a lot of personal use there. That is business use property. It's going to be used 100% for business. I don't think the doctor is going in on the weekends to use this MRI machine, okay? The last bullet point here is an asset can be both a personal use and a business use asset. These type of assets are called listed property, okay? And an example of listed property would be a vehicle, which is our topic today, or even a video camera. When I say video camera, I mean that video camera that you might use on vacations and that you also might use in your business for social media, okay? So listed property comes with its own set of rules. So that's what makes this topic quite complex to teach. It's because there's a whole special set of rules related to property that's considered listed property. So you can find this in section 280F of the code. And this is the part of the code that kind of governs all of the sort of depreciation of items that have, this unique property about them that it's personal and business use. So you can see some examples of what listed property is in the code is passenger automobiles. They exclude a few. We'll come to that later. Other modes of transportation, and look at the catch-all on the back. Any other, on the bottom, any other property of a type specified by the Secretary by regulation. So, but again, our topic is vehicles, so we're gonna stay on that point. I think the bottom two bullet points I'll come to later in the deck, so don't worry if I skip over that for now. But I wanna read the first few. You need to keep a log to determine if the property was what's called predominantly used for business. And what that means in plain English is, did you use this asset greater than 50% for business? So not 50% or below, but greater than 50%. If used greater than 50%, then we can use what's called accelerated depreciation. So we can use section 179, bonus, and makers. If used 50% or less, then you still can depreciate the property. It's just that you have to use straight line depreciation. So why did I put that in here? There's just a misconception out there that if I use my vehicle less than 50% for business, then I'm forced to use the mileage method. That's not true. You could actually use the actual method. It's just that you have to use the plain old-fashioned, straight line depreciation. Annual depreciation limits apply. We're going to talk about those in depth, so I'm not going to unpack them here now. So you've got options. And because you have all these options, I have to educate you on all these options, right? So that's why it's a bit of a challenge. You can lease, and if you lease, you can take the standard mileage rate, or you can take the actual expense method. You could also purchase, and if you purchase, those two options are available to you as well. The way I'm going to cover this is pretty much go from left to right. Okay, so we're going to cover leases first. So how does it work if you lease a vehicle, but you want to take the mileage method? If you choose the standard mileage rate method for a lease, you must use this method for the entire lease period, including renewals if you renew your lease. You cannot use the standard mileage rate method if you have 5 or more vehicles used in your business. Now, most people don't have that many vehicles used, but once you go over 4, you can't use the mileage method. You got to use the actual method, which I'm going to come to next on the following slide. Even if you purchase your vehicle and you're using the mileage method, I want you to pay attention here because the slide's going to be very similar, and I'm going to kind of skip over it. What's included in this standard mileage rate? So included in that rate is insurance. So what I'm saying here is you can't separately deduct your car insurance if you're using the mileage rate method. Included in that dollar amount that the IRS gives us, and I'll show you an example here on the next slide, is insurance, registration fees, repairs, maintenance, fuel, car washes. And I guess I probably could have wrote it there, but sort of depreciation is built into that amount as well. But in addition to the standard mileage rate, the following can be taken as a deduction. So you can also get a deduction for your state and local personal property taxes. Obviously, it would be the business use percentage of that amount is what you'll get the deduction for. And then parking fees and tolls. So parking fees and tolls are not included in that, 65.5 cents. And so you can take the deduction for that as well. But again, it's the business use of your parking. Okay, so let's look at a quick example. You have a lease, you're using the mileage method, you drive 10,000 miles for business, and the rate currently in 2023 is 65.5 cents a mile. What's your deduction? It's very simple. You just multiply it, it's $6,550. There are different mileage rates depending on the use of the vehicle. This is not very common, but I figured I'd add it because it's my topic. But 65.5 cents is the business cents per mile. If you were driving your vehicle for medical purposes, you can actually deduct 22 cents per mile, moving is 22 cents per mile. But all that's gonna happen more on the personal side of things, because most of you guys are entrepreneurs or tax professionals yourselves. And so you're going to be focused on that top line number. I just wanted to make you aware that there are other amounts you can take depending on how you're using your vehicle. Okay, what about if you leased your vehicle and you want to take the actual method? How does this work? So you get to deduct the lease payment depending on your business use percentage. What do I mean by that? I'm saying if you use your vehicle 80% for business, then 80% of your lease payment is deductible. But here you get to deduct insurance, fuel, same stuff you saw on the other side, really. License plates, maintenance, repairs, car washes, property taxes. You see the list there, right? So let's look at an example. Example is your lease payment is $800 a month, but you use this vehicle 80% for business. So we need to remove that 20%, right? So instead of deducting $800 a month, your deduction is $640. And then let's say all your other costs, meaning your fuel and insurance and all that other stuff, just summed up to $450. Then again, because you are keeping a mileage log and you know how much you're using your vehicle for business, you multiply by 80%, and that's $360. So your total deduction related to this lease vehicle for this particular month was $1,000, all right? Let's move on here. You really don't want to read this to you, but I have to. Okay? Most people overlook this. It's a detail, but it's technically correct, so I have to give it to you. So for cars, SUVs, trucks, and vans with a gross vehicle weight rating of 6,000 pounds or less, the IRS requires the taxpayer to add a lease inclusion amount to their gross income if the vehicle's fair market value is over a certain amount. For 2023, that fair market value amount is $60,000. The lease inclusion amount is designed to discourage small business owners from leasing luxury cars just to claim a larger write-off. The IRS publishes a lease inclusion table each year. I provided the link. There's no lease inclusion required if the vehicle would be exempt from the luxury car depreciation caps. I understand this is not English at this point. If the leasee owned the vehicle, for example, if an SUV, truck, van with a gross vehicle weight rating in excess of 6,000 pounds is leased, then no inclusion amount is required. Let me say that in plain English, which is I probably should have done from the beginning, but I wanted you to understand where this is coming from. To summarize that, I kind of did it in my own words below. So in summary, for 2023, if your client or you yourself are leasing a vehicle and you're using the actual method and the vehicle, at least for 2023, has a fair market value of 60,000, more than 60,000, and the vehicle weighs less than 6,000 pounds, that's when you have to be concerned about this, okay? But what is this, right? I haven't really explained that yet. What this just means is that there's a table, you have to look at it. Again, it starts at 60,000. If you're leasing a $90,000 vehicle, right, that's the bottom down here, it's just saying that whatever you calculated as your deduction, you need to reduce that deduction by these amounts. So in year one, you need to reduce it by about $204, and in years 5 through whatever, if you're still leasing your car after year 5, $926 needs to be added back. Another way of saying that is your deduction is getting reduced. You're not as able to take as large of a deduction. Like I said, I know that's a bit of a cluster, if you will. Don't be concerned with it because of all of the qualifying statements I wrote here down below. That's really for your tax professional to know and educate you on if you're a business owner. So don't worry about memorizing that if you're a business owner, okay? Okay, what about if you purchase? We're gonna move on to purchase now. If you purchase and use the mileage method, it's the exact same thing as the lease. There's only one exception, and that is, in addition to all the other items, is that you can actually deduct the interest on the auto loan, okay? Obviously, it's the business use percentage. So what I'm saying here is, if your car payments are really high nowadays, aren't they? If your car payment's, let's say $500, and the interest on your car payment is $100 of that 500 is interest, I'm saying whatever your business use percentage of that interest, that's an additional deduction above and beyond the mileage rate. So let's look at an example. It's the same example as before, right? 10,000 business miles, 65 and a half cents per mile. Your deduction is $6,550. What you can do though is add your interest expense to this. So your interest expense in our example below, I said $100 was interest and you're using your vehicle 80% for business, so $80 would be your interest expense. Okay. Couple of rules related to the mileage method, if this is what you elect. In order to use the standard mileage rate, you must choose to use it in the first year the vehicle is available for use in your business, okay? Technically, in later years, you can switch from the mileage method to the actual method. but it require you to use what's called straight line depreciation, meaning if you go from the mileage method to the actual method, you won't be able to use any type of what's called accelerated depreciation. So you can't use 179 or bonus, stuff like that. My personal note here was that this calculation is kind of a pain to determine. So make sure it makes sense to do this, because most times it might be advantageous to you to just stick with the mileage method. And you had heard this rule before. You can't operate 5 or more vehicles at the same time and use the mileage method. You'd have to use the actual expense method for all of it. Okay, here's where we really get into the weeds. Okay, so purchase, but you want to use the actual method. So what is deductible when using the actual expense method? We can do depreciation, right? And we're going to talk about this in depth. And there's going to be like a lot that we're going to talk about with this. Insurance, fuel, all the other stuff is these things you've seen already. But the main thing to take away is here is now that you own the vehicle, we can actually take a depreciation expense. Okay, here's my warning to you guys. There are a lot of nuances and confusing exceptions that apply to vehicles. I highly recommend that if you're a tax professional, to enter your client's exact scenario in your tax software to determine the depreciation calculation. What I really mean by that is the depreciation rules are quite complex. It's really not something you can memorize and know the answer to and spit out an answer to your client without, putting the numbers in your tax software and giving your client a number. There's so many rules, and you might get tripped up, and I'd prefer you do this than misquote your client on what that depreciation expense would be. Business owners, you should work with a tax professional and not rely on a TikTok video, because you've heard that enough times in this conference. Don't rely on a TikTok video for tax advice. Unless it's my TikTok video, then I give you permission. Okay. Okay. I don't know, bad joke maybe, but like the order of your, line dancing steps yesterday, again, can be quite intense. These is your order of operations for taking depreciation, okay? So let me pause for a moment and say, as tax professionals, for those of you that are tax pros, you didn't really have to worry about 179 too much in the past, because bonus depreciation in some cases would allow you to wipe out the whole cost of the vehicle, right? But now that's 80%, right? Not 100%. So if you really want to max out your depreciation expense on a vehicle, you want to take 179, then take bonus, and then even take makers. For you business owners out there, I understand that's like a foreign language. Don't worry about it. All those people that rose their hand and said they're tax professionals, I want you to go find them afterwards and have them unpack that for you, okay? But I'm gonna do my best to do it here. So a quick note, a reminder that Section 179 allows you to select how much you want to use on a particular asset. So what I mean by that is, let's say you purchase an asset and it allowed you to use Section 179 up to $28,000. Well, you as a taxpayer or you as a tax professional should be advising your clients, does that make sense? Do we really want to take that much? Maybe we just do 10,000 this year and use the rest in a future year, okay? Bonus depreciation doesn't work like that. Bonus depreciation is like, hey, if you want to use bonus depreciation, it's 80%. That's it. It's 80% or nothing, okay? And then, like I said, you could use makers after that. But by the time you get to makers, there might not be any really depreciable basis to even take at that point, okay? We're gonna unpack that, don't worry. Forgot to set my timer. So, hey, AV team, if you don't mind, can you give me a 10-minute warning before the class is up? Cool, thanks. Okay, this is the way I decided to try to break this down. Essentially, what I want you to know is that there's 3 categories of vehicles for the IRS, okay? So I'm gonna break those down for you. One is called passenger autos. So what is a passenger auto? It's basically a vehicle with the unloaded gross vehicle weight rating of 6,000 pounds or less. But if it's a truck or a van, I don't know why the IRS likes to do this to us, but if it's a truck or a van, it's actually a loaded gross vehicle weight rating. So small distinction there, not something for you to be concerned too much about, but just know that the difference between unloaded and loaded weight, okay? And then there's sort of subcategories within the passenger auto. So if the vehicle costs $61,000 or more, the IRS considers this a luxury auto, and they kind of penalize you a little bit for that, okay? I'll explain that in a second. Or if the cost of the vehicle is $61,000 or less, then it's considered, my words, non-luxury auto, okay? So that's category one. Category two is heavy vehicles. These are the Range Rovers that you've seen on TikTok, right? The G-Wagons, all those other cool cars. These are the ones that weigh over 6,000 pounds. Again, the distinction between unloaded and loaded. And they're over 6,000, but less than 14,000. So I'm calling them heavy vehicles, okay? And then we have a third category, which are vehicles that are not subject to depreciation limits. These are typically vehicles that have a gross vehicle weight rating over 14,000 pounds, or they're a vehicle that's heavily modified, and they're never gonna have personal use associated with them. I'll give you some examples later. Okay, here we go. So we're gonna unpack these like one by one. I'm gonna give you examples of these. And again, I'm gonna try to go a little bit actually faster now because I feel like I'm behind on my pace, but I want you to know that you have these slides and you can read them later. Maybe slow down my presentation when you watch it later. It can go to 0.75 speed if you need to, okay? So let's do passenger autos first. The amount of depreciation you could take on a passenger auto is limited by Section 280F, okay? Because it's listed property. The 2023 limitations are noted below and adjusted for inflation each year. These limits are, in year one, $12,200. However, if you're claiming bonus depreciation, it adds $8,000 to the limit in the first year only. So you can deduct up to $20,200. Year two, 19.5, year three, 11.7, year fours through forever, basically, 6,960 until the vehicle is fully depreciated. Now, I want you to know that these limitations are adjusted for inflation each year. So next year, it'll be a little bit higher. But what's not adjusted for inflation is the $8,000 of bonus. That stays there at $8,000. They have not adjusted that amount for inflation, okay? So look at this note at the bottom. You must reduce these limits and the first year depreciation taken by your personal use percentage. So as a result, the depreciation allowed may be less than the limits above. So it gets really tricky. This is why I said don't try to quote your client how much the depreciation expenses be, because you have to have all these things in the back of your mind. So I've got some examples for you. I'm going to spend some time on this example because the concept is going to be repeated on the next few slides. So if I lost you, come on back, take a deep breath, and we'll read this stuff together, okay? So this example is luxury passenger auto. What's a luxury passenger auto? We said it like weighed less than 6,000 pounds and it costs more than $60,000, right? So this vehicle is $70,000. We're using it 100% for business. It weighs 4,500 pounds, okay? What's our depreciation deduction? Well, we have a passenger auto limit of 12,200. So that's the cap. We can't go past that. However, if our client wants to elect bonus depreciation, then $8,000 is added to that. So our year one depreciation deduction with bonus for this vehicle is $20,200, okay? Now this note here is more for the tax professionals than the business owners because it's in the weeds for sure, but let's go through it. If you were trying to calculate the depreciation on this using makers only, you may think you'd be able to deduct $14,000. Where am I getting this from? The vehicle costs $70,000 and I'm multiplying that by 20%. You tax pros know where I'm getting that 20% number from? I see a couple of heads nodding in the back. Not nodding off, I'm not putting you to sleep, but you're nodding and saying yes. Basically, if you look at the IRS publication, I think it's 946, there's tables in there and tell you how much you would take each year for this type of property. So that's where that 20% is coming from you. You don't have to memorize that per se. I just want you to know why am I just randomly selecting 20%? It's because that's how much the tables say for the IRS tables say, okay? So 70,000 times 20% is 14 grand, but we can't take 14 grand, right? Because we have this limitation of 12,200. The limitation becomes more impactful as the cost of the vehicle increases. So if you had a $200,000 vehicle, right? Now we're talking real luxury, not just 80 grand. $200,000 vehicle, if I multiply that by 20%, one might think you could take $40,000 deduction in the first year, but it's not allowed because of the passenger auto limits. We can add bonus depreciation, so we can go to 20,200, but you'll notice that's definitely not 40 grand, right? So it's a difference of 19,800. I'll show you this a little bit later, but these limitations would occur each year to the point where that $200,000 vehicle, you'd be depreciating that for 20 years before you fully depreciated the vehicle, right? In 20 years, I don't know where that vehicle is going to be. You probably won't be owning it. Okay, now, because I'm thorough, I decided to include some examples of 80% business use, okay? Because this is the reality, right? Our client might tell us, and you guys as the business owners might tell us, oh yeah, I use that thing 100% for business, never go grocery shopping with that thing, never carrying my kids around, none of that stuff, right? The reality is, it's more likely that you're using 80% for business. So I want to show you an example of this, okay? So same facts, except that we're using it 80% for business. $70,000 vehicle weighs this much, but we're using it 80%. Well, now what we have to do, we actually have to reduce the limits, the passenger auto limits, by our personal use percentage. So instead of the limit being 12,200, it's now 9,760. And we have to reduce bonus depreciation too. So instead of 8,000, it's 6,400. So our year one depreciation deduction with bonus is $16,160. I have the math down here if you want to follow it later, but essentially I kind of explained to you why it's that way. It's because we have to account for the personal use percentage of the vehicle. Okay, what about non-luxury auto, right? So this is our vehicles that weigh less than 4,500, less than 6,000 pounds, but they don't cost more than $61,000. How does this work? Well, basically, those passenger auto limits that I showed you a couple slides ago, they never really have an opportunity to kick in because the vehicle just didn't cost that much to begin with, okay? So they don't really come into play, kinda, okay? So let's look at this. So I said not considered luxury, so the cost recovery limits do not come into play when calculating depreciation using regular makers. However, when using bonus, those limits come back into play. So if you claim first year bonus depreciation of $8,000, then the non-luxury auto can cost, oh, this is another fact pattern, okay? So if you claim first year bonus depreciation of $8,000, then technically your non-luxury auto could cost more than the $61,000. It could cost up to $69,000. This is because the $61,000 amount is after special depreciation allowance is considered. That's a super technical fact. It's probably not going to come across very much, but I'm too thorough, so I added it in here for you guys, okay? Okay, now let's look at this example. So non-luxury vehicle, but 100% business use. So this vehicle costs $35,000. Use 100% for business. The vehicle weighs 4,500 pounds. What's our depreciation deduction? Well, the year one maker's amount that you could take is $7,000. And because this is less than 12.2, we're not worrying about the limits, right? So the takeaway here is like, okay, I kind of got you, Navi. What you're saying is, since the vehicle costs less than 61,000, I don't ever have to worry about those limits because I'm never going to hit them to begin with, okay? However, if you decide that you want to take bonus depreciation, the depreciation deduction is increased all the way up to the year one limit of 20,200. So that was the 12.2 plus the 8,000. So a lot of people are like, oh, let me go buy that heavy vehicle that weighs over 6,000 pounds and costs me, 80 grand. But I'm here telling you right now, you could buy a more reasonable vehicle of $35,000 and in year one, still deduct 20,200, which is very impactful. I think that's substantial to know that, right? What about if I use the vehicle 80% for business? Well, it's the same concept as I had below on the other slide. I'm just saying your depreciation deduction needs to account for the fact that this is 80% business use. So the technical term here is my depreciable basis is being reduced by 20%. My maker's depreciation deduction is reduced. And then also my bonus depreciation deduction. So all I'm trying to say here is like, you buy a $35,000 vehicle, you're using it 80% for business, you can still write off a big chunk of it, $16,160. Okay. Admittedly, I could have done better on this slide. Okay, it's not very intuitive. Let me explain what I was trying to get at here. What I'm trying to show you is each column is the examples that we just kind of went through. And I want to compare column 1 with column 3. And what I want to tell you here is like, what's happening behind the scenes is the IRS is saying like, hey, that's cool, go buy that luxury vehicle, but the maximum you can take in year one is $20,200. Why $20,200? It's because, hey, that's what you can take when you have a non-luxury vehicle. It's not super impactful when I give you a $70,000 example, but going back to the $200,000 vehicle example, right? You wouldn't fully depreciate this vehicle until year 24, okay? Whereas with this more reasonable cost vehicle, you could fully depreciate it after year 6. So that's what's happening there. It's a limitation that they're putting on these luxury vehicles. Okay, so again, here's the heavy vehicles, right? This is what you see all the TikTok videos about. The vehicle weighs over 6,000 pounds, cost 100 grand, sometimes 200 grand, sometimes $250,000. And it's true, you can write off the whole thing in a year in 2022, right? In 2023, we've got some calculations to make, okay? So these are not considered passenger autos. We're in a different type of vehicle right now, right? These are heavy vehicles. And so as a result, they're not subject to all those passenger auto limits that I was, kind of confusing you about before. However, there are Section 179 limits, but they're higher than the luxury auto limits I mentioned below, before. It's 28,900. 80% bonus depreciation limit in 2023, and as you guys have probably heard by now, not just from me, but Mandy and the others, this is on a sliding scale going down each year. And then makers would apply to remaining depreciable basis. I think you guys as tax pros are going to be more interested in the mechanics of how this works than the entrepreneurs, but bear with me, entrepreneurs, while I go through this. Let's look at an example. So you bought an $80,000 vehicle. It's used 100% for business. It weighs over 6,000 pounds. What's my depreciation deduction? Well, if I didn't take Section 179 or bonus, my year one maker's depreciation deduction would be $16,000, okay? I wanted to call that out here because I wanted you to see visually, oh, we don't have to worry about that $12,200 passenger auto limit anymore. So it's $16,000. But what you might want to do is if you want to take Section 179 on the heavy vehicle, we have the Section 179 limit, which is 28,900, right? So we take 80 grand, we subtract 28,900, and now our depreciable basis is 51,100. Now, your clients and you yourself, if you do this for your own business, is you can now take bonus depreciation on the 51,100. So we're going 80% since we're in 2023. And so we're getting to depreciate 40,880 in bonus, okay? And now our depreciable basis is 10,220. So now we apply makers on this amount. There's that 20% that you saw earlier that I unpacked for you. So you can deduct $2,044 using makers. So $80,000 vehicle, use 100%. Our depreciation expense is almost $72,000. So I don't want you guys to think, oh, I blew it. I could have used bonus last year and I didn't. You can still use it this year and write off a really huge chunk of that vehicle. So don't think like, you should have done it last year or get upset at yourself. You can take a quite large of a deduction for this. I got an 80% used vehicle example here. Do you guys want me to go through this? Or do you want me to be like, I kind of got it. Raise your hand if you want me to go through this. 80%. Okay, okay. Pat wants it, so I'm gonna give Pat what he wants. Okay, so I'll go through it quick, okay? $80,000 vehicle, 80% used for business. So we have to reduce the depreciable basis, right? It's $80,000, but our personal use is 20%. So 80,000 times 80% is $64,000. Then I want to take Section 179 first, but that cap of 28,900, I've got to reduce that by my personal use percentage. So I can't take 28,900, but I can take 23,120. So now my depreciable basis is 40,880. Then I can use bonus depreciation of 80% of that number. Now my basis is down to 8176. I can add makers to that, but I got to reduce my makers by the 20% personal use. And so essentially what you need to know is you bought an $80,000 vehicle. We said that the actual business use of that vehicle is 64,000. And so of the 64,000, you could deduct almost $58,000. So it's still pretty significant. You'll unpack that later, right? Vehicles not subject to limitation. So this was the third category. We had passenger autos, then we had heavy vehicles. Now we have vehicles that don't even have any limits, okay? So there's a laundry list of things that you see here. Essentially, these are the vehicles that weigh over 14,000 pounds. And the reason why there's no limits on these is because the IRS kind of says like, hey, for these vehicles, we don't think you're really ever going to use these personally at all. Okay, so if you look at the examples here, we have like a shuttle vehicle having more than 9 passengers behind the driver's seat, right? And there's different things. I mentioned I was gonna come back to the ambulances and work trucks and hearses. Like, I mean, some people drive a hearse as a daily driver. I don't, but some people do. And so they're just saying like, these are just not practical as vehicles that you would use personally. So the IRS kind of considers them equipment and not vehicle used for business. One thing I did wanted to point out here, and someone had asked me about this yesterday, is like, if you have like a taxi business or like you drive for Lyft or Uber or whatever, it actually falls under this category, not those passenger auto limits. So you could actually use Section 179 and deduct 100% of that vehicle. So if you see like a Toyota Prius and there's a Lyft driver in there, they technically could deduct 100% of the cost of that vehicle in the first year. They don't have to worry about all that math that I mentioned previously. Okay, predominant use, I mentioned this already. I'm saying if you use the vehicle less than 50% for business, you can still depreciate the vehicle. You're not forced to use the mileage method, but you just have to use straight line, okay? Here's something I think I wanted to talk about. Along these lines, if you accelerate the depreciation on the vehicle and you then use the vehicle 50% or less, okay? You will have to recapture the depreciation over and above what straight line depreciation would have been. Let me say that like in plain English. What I mean by that is like in year 1, if you took bonus depreciation and you depreciated like the whole thing last year, and then this year your business use drops below 50%, you're gonna have to recapture all that excess depreciation that you took. So the takeaway from there is keep your vehicle use at 50% or above 50%, okay? Tax strategies. Everything I just said before was like facts. Hey, this is how it works. This is how you implement it, right? Here's some strategy here. For Schedule C filers that are subject to self-employment tax, should you take accelerated depreciation, which could offset your business income and maybe other income you have, such as W-2 income? If so, keep in mind you won't be offsetting self-employment tax when the loss begins to offset that W-2 income. It might be better to take that depreciation over a longer period of time. So tax professionals out there and entrepreneurs out there, if you are buying a vehicle where you have a lot of depreciation and it offsets all the profit in your business, it may not be the best thing to have it offset W-2 income, because that deduction is more powerful if it's also helping you offset self-employment tax at roughly 15%. I think you'll like this one. So putting vehicle in service on December 30th, 2023. So you buy this vehicle this month for Christmas for yourself, right? You drive it 100% for business just here, right? You put the vehicle in service on December 30th. You drive around for business purposes, so you use it 100% for business. You can deduct as much as possible. And in future years, as long as you continue to drive it more than 50% for business, you don't have to recapture the depreciation, right? Yeah, you don't have to recapture the depreciation unless you sold the vehicle. So the strategy is, if you think back to a slide, many slides ago, where I was like, you bought this $80,000 vehicle, use it 100% for business, you got like some $72,000 deduction. Well, in year 2, and 2 and forward, as long as you use the vehicle greater than 50%, you won't ever have to recapture. So that's kind of like a strategy if you put a vehicle in service in towards the end of the year. How am I doing on time? AV guys? Doing all right, cool. All right, recapture. This is that word that everyone hates. It's like as bad as the F word. FICA, not that other F word. Recapture. So if you sell or trade in a vehicle, the amount you sold it for or received a trade-in value for will have to be considered for depreciation recapture. For example, you purchased a $50,000 vehicle and you depreciated your entire cost basis. Your what's called adjusted basis is now $0. So on your books, this vehicle is not worth anything, okay? If you sell that vehicle and it's now worth $30,000, let's say 2 years later, it's worth $30,000, you'll have to recapture. What that means in plain English is pay ordinary income tax rates on the $30,000. Did that click? You understand what's going on there? Okay, cool. If for some reason, this is very rare, but it happened during COVID, so I'm including it. If for some reason you sold a vehicle for more than you purchased it for, remember you purchased it for 50 grand, but let's say you sold a vehicle for greater than $50,000, well, that would be called something called Section 1231 gain, which would be taxed at long-term capital gains rates, which are more favorable than your ordinary income tax rates. Again, that's probably never gonna happen again, but that was more like, hey, I bought this, Toyota Tacoma for 40 grand, and during COVID, it's now worth 55. This is what would happen there, okay? Oh boy, I'm gonna ruffle some feathers here. Here we go. Accountable plan or book. So these are for my accountants out there. How do you handle this? Do you reimburse these expenses through an accountable plan, or is this asset actually on the books of your business? So there's a lot of words here. Essentially what this slide is saying is if you use a vehicle less than 100% for business, the vehicle nor its loan, interest expense, accumulated depreciation, all those things that go along with it should be on the books of your business, meaning should be hitting the P&L or the balance sheet of your corporation. Instead, use an accountable plan to reimburse the shareholder employee for his or her business use of the vehicle. Here's where you can find and read about accountable plans and how they work. But essentially, if you don't have an accountable plan, by default, you have a non-accountable plan, and you won't get this benefit in this second bullet point here. The employee will receive the reimbursement tax-free, and the business will record an expense for the reimbursement. If you don't do it this way, if you don't flow this through an accountable plan, then essentially, like I said a moment ago, you have a non-accountable plan, and now those reimbursements are subject to income tax. So make sure you're flowing this through an accountable plan. I want you to think about this logically. A lot of people get screwed up here. If you worked for a company and used your vehicle 80% for business, you would submit an expense report and receive the reimbursement, right? That's how that would work. Essentially, that's what an accountable plan is. But look at the other sentence here. The company would not put 80% of the vehicle on their balance sheet, would they? If you worked for Google and you just happen to use your vehicle a lot for your job at Google, you'd send them an expense report and say, hey, this is what I use my vehicle for, reimburse me. And they'd say, cool. But when you pulled up Google's financial statements, would they have 80% of your personal vehicle on their books? No, right? That doesn't make sense. So I want you to use that same logic with your own business and your client's business. Okay. Here's proof about the accountable plan, because I know a lot of people question this. Here's proof about the accountable plan and that you can actually reimburse the employee for expenses such as Sections 179 and bonus. I know it seems silly, but you can reimburse for these things. And here's the court cases and private letter rulings that talked about those things. You can look at those later. Now, when do you put the asset on the books of the business? You put the asset on the books when the vehicle is 100% business use, okay? That's when they go on the books. And the business will pay for everything. The business pays for the vehicle, the repairs, fuel, interest expense, everything. Any personal use, right, that happens is going to be added to the shareholder employee's W-2 wages. It's what it's called, the technical term is a taxable non-cash fringe benefit. There are 3 common exceptions where you wouldn't have to add it to wages. They're de minimis. So if you quickly stopped off to the grocery store and then went home, you'd probably be fine there. A non-personal use vehicle, that would be the hearse, okay, that you're probably not using personally. Or demonstration vehicles, this is sales managers at a auto dealership. That's typically when this comes into play. There's different methods you can use to determine how much you need to add to the employee's wages. They're listed here and in publication 15B, so you can check that out later. Okay, administrative home office. Why this is in here? Because it relates to your business use percentage, and if you're using the mileage method, how many of your miles are business versus commuting. I'm going to read this to you. If you establish an administrative home office, you eliminate your commuting miles. Just be sure that you have a second office, just be sure that if you have a second office location, you do not perform administrative work at the second office as well. So for example, if you're a dentist, when you go to your office to see patients, don't perform your administrative work there. Perform your bookkeeping and pay your bills and all that stuff from your home office only. And this IRS publication says your home office will qualify as a principal place of business if you meet the following requirements. You use it exclusively and regularly for administrative or management activities for your trade or business. You have no other fixed location where you conduct substantial administrative or management activities of your trade or business. So here's a visualization of that, right? On the left, we have what not to do, which is you just have a home, no home office. The C means commuting miles, so they're not a business deduction. You go to office location 1, and then you decide to have lunch because it's Taco Tuesday and you want to do unlimited tacos. So you're getting business miles here. This is business on your, from lunch back to the second office location. And then these are commuting. So essentially what I'm saying here is like all of these miles, no matter how much they are commuting miles, not business miles. But if you have that home office with your, dual monitor setup, shout out to all my dual monitor people with 3 and 4 monitors, right? This would be okay. Now we've converted this from commute to business, and the same on the way back.
Okay, so guys, I get it. That was a long video, and even still, I was only able to teach you about the topic of deducting your auto. I encourage you to click on the link in the description below or visit my website at navimuradcpa.com to learn even more about the course that I mentioned earlier, because in this video, I just had some limited time, but in the course, I unpack all of the tax strategies I use with my very own clients. And I actually teach you how to implement them using QuickBooks, as well as the details about how the strategy actually works. And so although this is a course designed for a beginner, I even have tax preparers, bookkeepers, and CPAs enrolled in the program, and they all have nothing but great things to say. All right, with that said, I'll either see you in the course or in the next video.